Well, good afternoon, everybody. Investors in the middle of the afternoon. Looking forward to sharing some ideas. My name is Mark Robertson. I am founding partner and managing partner of Manifest Investing. I'm joined here by my colleague, Ken Kavula. Ken is known nationally for his educational sessions and campaigns and national events. Good afternoon, Ken.
Good afternoon. Glad to see such a hearty audience with us this afternoon.
A lot of regulars. There's a few new names in there, so we do tend to keep this informal. Did you see
I'm
that?
surprised we have a fair number of new names on the list this afternoon. That's great.
So keep in mind that Ken will be manning the questions tab. If you have a comment or if you have something you'd like to see a little more depth on, we can do that. Sean will probably not be joining us because he's had to keep his schedule open for Tesla to come and install solar panels on his home. So we will probably be getting a full econometric analysis of solar panels sometime soon.
All right.
All right. And Ken, that clock is running out. And I got to tell you, we were like on the original $2,000 investment, we were $210 behind. And suddenly we were $140 or $150 behind. And I thought there was a hope and a glimmer of potential that we might catch up on the best small companies, but it has since retreated to that $200 deficit is kind of back in place. So time is
I noticed
running out.
Green Brick Partners took a big move up. Whether it was yesterday or today, I'm not sure, Mark, but I know that it took a really big double-digit percentage move in one direction.
Well, we'll see that on the slide here in a few minutes. So there's a couple of companies on the move, but I don't think it's going to be enough. But that's exactly why I switched away from the white vested Ed Harris and I brought in the darker cowboy Ed Harris from Westworld, because we're trying to scare those rabbits into action, because if they don't perform better, Ken and I are going to be probably imbibing some of that beverage in the middle of the screen. Dead Rabbit Irish whiskey here in a few days.
Dead Rabbit. I have to look for that. I have to go to my specialty liquor store and look for Dead Rabbit, Mark, you know?
Well, if you find it, I'll come and help you.
Is this an actual whiskey, or is this a made-up kind of a whiskey?
No, it's the real McCoy that one of the Motley Fool principals brought back from Ireland.
From Ireland, okay.
And if we need to send Matt Spielman on a field trip, we can do that too.
All right.
And of course, we are winding down towards Halloween. Halloween is our annual reminder for get out there and just like a trick-or-treater, try to find the treats among the tricks. And a tradition that started long ago with the Forbes Best Small Company list. And today we're going to take a look at two sources of ideas for analysis, one being the emerging companies published by Hoover's Handbook of Emerging Companies. And then we're also going to dive into some of the best performing, the best sources of ideas, in my opinion, that we've ever seen for small company ideas. We'll have some examples of that, and that will continue in earnest over the next several days. Ken and I have basically decided to hold a special bull session a week from today. It'll be an evening session that will feature our selections for the best small companies for 2023. So is that still good for you, Ken?
I think that's excellent for me, Mark.
So we'll call it a special bull session and combine it with our best small company, and it'll probably run a little over an hour. We're gonna focus in on some fairly high conviction picks and try to get back on the rails. So with that, let's go ahead and get underway. Here's our standard disclaimer that no investment recommendation is intended. This is entirely about education, specifically the demonstration of some principles that are over 8 decades in the making, lessons learned by the modern investment club movement that we are attempting to interpret and deploy. And everything that we do here is basically to illustrate that deployment, whether it's identification and discovery of individual opportunities or the management, design and management of portfolios. So you'll hear our opinions about that. please do your own homework before making any type of a decision. We will own companies that are in these portfolios. We'll try to remember to let you know. Specifically, we put together portfolios that at M1 Charts, which we can talk about a little bit later. M1 is a brokerage firm, so I actually own all the companies in the best small company list for this year. But we'll talk a little bit more about that later. And tonight we do have a roundtable. If you'd like to be added to the monthly webcast, it's always on or at least usually, is on the last Tuesday of the month at 8:30 Eastern Time. It is a webcast. It is free, and it's wide open to the public. Please send a reminder request to nkavula1@comcast.net. If you have any other type of follow-up, if you'd like copies of slides, we do share all of these slides at Manifest Investing in the forum under these individual bull session, actually in the forum. So you can write to either one of us at those two email addresses at the bottom. Anything you want to add, Ken?
Nope, I'm ready to get going, Mark.
All right, here's our traditional graph, and I wanted to just take a moment to answer the question which I've received a couple times. And I'm doing air quotes now, Ken, what's air quotes normal? So what would be a normal range? Tackling that question as a mathematician, that's what you see on your screen. What you're looking at is our traditional graph, which is basically the market. The green bars are the value line arithmetic average. That's an index built from the prices in the value line standard edition. And you can see that it's bumped up, it zigs, it zags. And the blue line is simply exponential regression through those green bars. So you can see that it basically dashes above the blue line and then it sinks back below the blue line. And we happen to believe that at some point we will go back to the blue line because we've actually sagged down a little bit below it. The red bars, and that's what the shaded in area is based on, it's basically the average forecast of the companies in the value line standard edition. And it's basically looking out, and it's their 3 to 5 year return forecast. It's basically appreciation focused. But so what you're looking at is that dotted line down the middle is just short of 12% on average for the time period shown. And what I've done is I've basically included plus or minus one standard deviation. And of course, Ken, the calculus professor, can correct me if I'm doing any of this wrong, but anything in that shaded range is basically within one standard deviation, which means it's happening, what's the number, Ken? Something like 66% of the time?
Somewhere around 2/3, yeah.
Something like that. So if you're in that zone, you're basically in what could be considered a air quotes normal range. So you can see that we obviously tucked up above it, end of that glorious decade known as the late 1990s, and then again in 2008 when the wheels came off, and then most recently with COVID, with the spike that you can see on the right-hand side of the chart. Right here, this was the COVID spike when, the stocks didn't look too bad, but it did spike up. And most recently, we spiked down to fairly historical lows. If you look at these points right in here, a little tough to see, but those points where they're off the charts kind of low, outside that standard deviation range, basically another form of suggesting that some of this was a little frothy. Highly technical term. What are your thoughts, Ken?
Well, I just want to make the point that we're used to seeing straight lines when we do our graphs on stock selection guides and those types of graphs, because that straight line shows consistent growth. But that's when you do your graphing on a different kind of graph paper. When you use a graph paper that is uniform in its up-down axis right there, and this one has a little line every 2%, you can tell, then consistent growth doesn't graph as a straight line. It graphs as a piece of a parabola. And so that blue line is giving us this curve, but that is what consistent growth looks like when you graph it on just plain old graph paper. So we are getting consistent growth in the stock market. It's just very unpredictable year to year. And when you hear us talk about the average over long periods of time being somewhere around 10, I think that has to do with the fact that a lot of stock market averages are aimed at what the large cap stocks tend to be doing, the S&P 500, the Dow, stocks that are in those types of indexes. And when you include all of the above investing, looking at small companies and medium-sized companies and large companies, I think you tend to increase your average to somewhere, as this graph is showing us, to somewhere around 12%. And Value Line certainly is a great proponent of all of the above advertising. And when you look at their average, you're certainly taking into account an awful lot of small companies and medium and large as well. Now, it does include the Dow stocks. It does include the S&P 500, but then it goes well beyond those two very large cap indexes. And that's the reason I think we're looking at around, you probably could safely say 11.5 to 12.5% long-term average versus a 9.5 to maybe 10.5% long-term average for the larger stocks that we look at and that we cite when we talk historical numbers most of the time, because those indexes have been around a lot longer than indexes like the Value Line.
Absolutely. And we're currently sitting at a point where stocks have come down. They've regressed a little bit to the low side when it comes to stock prices in general. There are more stocks in the buy zone on the stock selection guide stock study. So that's basically shown there. So let's keep pressing on. I'd forgotten I put this one in here, but this one's kind of an interesting, just little snippet of information, something that I look at. And what this is just taking the forecast variability of the companies in the standard edition, looking back to the days when we started Manifest Investing back in late 2004. And all we're looking at is how much, again, this is measuring statistically, it's in standard deviations, the amount of variability. And, when are the rhinos, hence the picture of the rhino, we refer to the Wall Street institutional analysts as rhinos. When do they get confused, and how does that line up with economic events? Call them special events if you want. You can see that back in the 2008 timeframe, it became challenging to the analysts when the stock market actually dove down and had a moment. And then you can see that, and this one was really aggravated, and we've talked about it here, about how the pendulum was basically beaten, dented like a Sabalenka tennis racket on the side of the highway. Analysts really were all over the map. And lo and behold, we're not that far removed from another one of those moments. Two really interesting moments in terms of the difficulty of forecasting what lies ahead. I don't think the shock waves are done yet from from what happened during the pandemic and some of the monetary stuff that happened as a result. And so that just shows it in kind of a picture form that we're in the middle of a moment in the stock market. So I don't know, calculus professor, are you okay with this too?
Well, I'm really okay with the graph, and I'm thinking to myself that that second one that you circled, the pandemic itself, was so unusual that I think every single bar after that is probably a pretty unusual response to something that we've never been in the middle of before, and maybe we were really wrong to think that it was all over within a quarter in 2019, and maybe the echoes have to progress every couple of months or every couple of quarters until we get back to something approaching normalcy.
Yeah, the amount of forecast variation has definitely trended up over the last couple of years. So I think getting back to somewhere around these levels that you see down the middle of the chart would be a welcome thing. I actually think it has a lot to do with the results we're about to talk about with the groundhog and best small companies too, really. All right. And here's your tweet for the moment. This is really the worst news you're going to see today. Are you aware of this, Ken?
I'm not aware of this indicator. No.
I mean, I'm going to go out and buy a bunch of them and freeze them, I think, because if they're going away for good, I'm going to need something to get me through tough times in the stock market. And here's why. Sean actually brought this to us a year ago. It compares the returns in the stock market on days when the McRib is offered by McDonald's versus days without. And we're in a world of hurt here if they make this thing go away. So I'd say write your congressman, write your senator, write to the officers of McDonald's and say, please, don't do this to us.
Well, we've heard. I do have enough history to know that never bringing it back has always been something that McDonald's has toyed with every single time it stops offering it, and then suddenly a year later or 2 years later or whenever it's back again. So I don't know if I believe them when they say it's never coming back. Obviously, pretty popular.
You're saying this could be a gimmick?
I'm saying it could be a gimmick. Yeah.
Okay. Maybe we're safe. All right. Time will tell. All right. So on to the more serious stuff. Hey, this is kind of cool too. Kirk Coates has taken over the lead as the individual on the individual board. Einhorn, of course, continues to lock down the celebrity guest groundhog. But the standings up at the top are pretty constant with Lisa and Herb and Nick and Marilyn and Kay's husband. Sean continues to be in the top 20. The Monkey's still in the top 20. A couple of clubs, one from the Dallas area, and one of Kevin Galogli's clubs from the Maryland or Metro DC Metro area. But we are all in the boat of struggling together. I mean, there's only one entry on here above the original $1 million in groundhog dollars. So it's been a painful time frame for not just the best small companies, but I think this kind of ties back to that chart of forecasting has been a little more challenging over the last couple of years. And I believe you're hovering somewhere around 50 or 55, Ken, in case you're searching for your name.
Oh, no, I know that I've lost a little bit of ground in the most recent week or so. I'm getting some comments. First of all, Len, thank you for all the history about the whiskey. Len has done his normal 40-second research for us, and he has more than you ever want to know about that whiskey on the question box there, Mark. So take a look. It actually comes from a bar in New York City, evidently, that blended the whiskey to start with. I'm getting a lot of stuff, however, from people that are trying to read the tea leaves in your graphs. And I would just urge everybody to not take any graphs so seriously that you base all of your investing chips on the basis of what a graph might do, because graphs, from my point of view at least, they move in pretty random directions over longer periods of time than just a couple days or a couple of weeks. So I wouldn't base all my buying and selling on a single graph. I wouldn't even base it on a collection of graphs. I would just make sure that, from my point of view at least, I'd be investing regularly and buying good companies at great prices. Maybe great companies at great prices.
Yeah, I would base all of my investing on this one. The point being, we're down around 7,500 or 8. I happen to believe that we're going to be somewhere around this 4 years from now. That's 14. That's basically the return on an average stock in the low teens. I believe that to be true. So what Ken just said, invest regularly in excellent, well-managed companies, and you'll probably enjoy that blue line.
I guess what I'm saying, Mark, is that for longer periods of time, I would not say, for example, that this graph suggests you stay out of the market for a year.
Oh, never.
I would not make any long-term forecast based on a single graph that wasn't backed up by fairly regular investing, so that you can have money in the market when the market does what you don't expect it to do. And I guess that includes going down as well as up.
Yep, I would agree with that. So the results continue to be dismal. The returns have actually improved, but not enough. The number of participants, keep in mind, just to give perspective here in context, we're used to seeing 60% right here. And that just shows you how challenging it has been. And Kathy actually has a contender that's trying to drop down and take her out of 166th. So we'll keep hoping so that we get a change there so the slide changes. And at number 44, Nick DiVirgilio can probably help out with that whiskey.
All right.
The New York influence. All right, here's a look at, again, context. Context being, even if our 7-year winning streak ends, as the clock runs out, it's still a pretty good story. And I don't know, I suppose we could write volumes about humility and all that kind of stuff. And the fact that we are not actually surprised by this, we lament the fact that that might happen. We'd hope to catch Bill Miller and the winning streak Legg Mason value he had several years ago. But when you look at, even with the fairly disappointing results so far for 2022, we are still running 6.5 percentage points better than the total stock market. So I guess we don't cry in our beer too much, Ken.
Ann is asking Mark if the Phillies are giving us a sign like the McRib. They won the World Series in 1929. Keep that date in mind. 1980 and 2008. Is that a warning sign, just like the McRib, do you think?
Well, if the Phillies beat the Astros, yeah, we probably just all head for the bunker. That'll make all the Philadelphia people out there happy.
And then we're getting our usual anti-Philly rants and pro-Philly rants. So I can't do anything about whether you're rooting for them or against them, guys. So you no need to tell me in the question box, okay?
All of you out there, for those of us that are Cardinal fans or Guardian fans, also known as the Indians, or Detroit Tiger fans, our baseball seasons are over. So we've moved on to golf. All right, speaking of moving on, here's the list of companies. And yeah, you're right, Ken. I think Green Brick took a pretty good jump here recently. And so did check this out, Ken.
I'm noticing Boston Beer is positive relative return.
That? I mean, I was out there. I mean, I'm running around out on Cape Cod telling people to throw their Truly into the bay.
You did a really good job. You must have had some open houses in Rochester as well, Mark. You know, those streets are fairly close together. What you do? Run around and invite 300 people to a party every other weekend, or?
Well, it was a big wedding that I was at, and there was some
big wedding. Okay,
big wedding. Right across from Martha's Vineyard. Had never been there. Really kind of cool. The other one that's been really neat, because I got to take credit when I get a win, because my wins are often offset by others. The problems in the oil and gasoline fuel prices has actually been pretty good to a lot of the energy companies, including this one. And so these companies are helping us out a little bit. Green Brick might go positive by the time we're done here. And of course, my Rand pack isn't working out very well. So next week, I think we probably, I don't know if it'll be next week or the week after, but we got, I don't know if I sent it to you, Ken, a car guru stock watcher wants to talk about what's happened with the car gurus. I think it's going to be a fun conversation. Well,
it'll be very interesting. We own CarMax in one of our investment clubs that I'm involved with. So I'll be listening with bated breath because I think they're pretty similar stories to each other.
Yeah, and I think the car gurus thing goes with that picture of the rhino and the fluctuating uh, forecasts too. So it'll be interesting to see what we see when we dig in a little
We
bit deeper.
we studied the automotive retail industry in two clubs that I'm involved with about a year ago. And in one of the clubs, we brought it down to CarMax, and that's what we invested in. And in the other club, we brought it down to a lesser known stock called Lithia Motors.
Mm.
LAD is the ticker for it. And Lithia has just been eating the lunch of CarMax here. We liked them both, and one club chose one and one club chose the other, and very interesting backstory to what's going on. And I'd be very, very interested in listening to the discussion that's going to come from the CarMax guy.
Well, that's good diversification. It reminds me of the time that I helped Dad to buy Walgreens, and I helped Mom to buy CVS, and I had to sleep in the car in the driveway for the next couple of years.
I'm just thinking about your Colgate Procter and Gamble issue also, you
I was
know.
there too. All right, so this is winding down. We'll have a final result here in a few days. You guys all know this. If you're new to the session here today, this is just a fairly broad brush sample of the places we turn and look. We still believe in Kathy Wood. I think she's just getting her head handed to her by the characteristics of the current economy and market and some of the early stage investing she does. Now, I know some of her investments make Ken really uncomfortable, but if she sticks to her guns, I think she's going to be fine, and I think she will. But the Motley Fools, Y charts, basically haystacks of needles. I tried to go to the Fortune 100 companies. They published something in August last year. They haven't published it yet this year.
No, haven't found anything for anything dated 2022. Haven't found anything
Right.
in any of my magazines. And
They
I
did.
expanded my search to the business. It used to be the Business Weekly, but it's on a different name now. But I extended the search there, and
Yeah.
I'm not finding anything there either.
Yeah. So that one's probably not going to come up. And then, of course, we continue to monitor social media. And one of the things we are going to talk about here today is Hoover's Handbook of Emerging Companies, which has been a very powerful source over the years for me. So these are some of the places we turn. The guy in the middle of the chart is Chris Jenner right here. And he used to run T. Rowe Price Health Sciences, and really good health technology stock picker. Here's the current list of candidates that we have kicked around. It's not complete. I stopped it at a manifest ranking of 80. It was originally ranked by manifest ranking, so that's a combination of the return forecast and the quality. We're trying to not tolerate anything too low. This one's pushing it a little bit down here at 49. But from top to bottom, you can see some of the situation. And I mentioned Ken will be debating as to whether or not $2 billion is too much for these companies to stay in here. So we'll have that debate, but pretty wide berth of companies here. Some regional banks here. We obviously can't pick more than a couple regional banks at most if we're going to keep it to the numbers we're talking about. You're going to have to pick a favorite, Ken. I know that kind of gives you the heebie-jeebies.
Well, I know a couple that I don't like, so that's good too. That's real good. So
That can be helpful. All right, so these are ranked by those two characteristics. So we do like to see the projected return on values basically correlating fairly well with the projected annual return that's shown here. And some other opinions from the Morningstar, analyst consensus estimates, and Value Line actually covers a pretty good handful of these companies. And we are influenced by Value Line somewhat. All right, so let's keep moving on and talking about where any contenders might come from. This is actually a pretty cool list. What I've done here is gone into the funds that we cover and hopefully restored to your fingertips at Manifest fairly soon. But These are sorted by highest growth, descending growth. And again, that is either for an industrial company, that is the sales growth forecast. For an asset-based company, it is the book value growth. And we're looking for anything above 12% as a place to go hunting. Keep in mind that we're looking at a list of funds, top to bottom, whether they be traditional mutual funds. A traditional mutual fund is going to have this M prefix in the ticker. If it's not a traditional mutual fund, it's lacking the M, then it's an exchange traded fund, an ETF. And pretty good list from top to bottom. The key feature is over here, the relative return of all these funds is actually positive. That means it's beating the general stock market over this approximately 10-year period for all but one fund. One of the Motley Fool funds sneaks in here with a shorter operating history. But for everybody else, it's about a 10-year period. So we're looking at a group of faster growing companies that are selected by people who seem to know what they're doing in general. And some of them are, of course, broad indices. But we like to basically start shopping for ideas from people who seem to know what they're doing. So pretty powerful chart as you go looking. We're going to actually demonstrate this in a second. Anything else jump off this page that you can?
Well, I'm fascinated by these that can grow 8 and 9%. And that's where, as I do my whittling down, I'm going to do some special attention on those 3 or 4 on this list that are growing so much more than the average on the list. I want to see if there's any reason that they can turn out that kind of growth when the vast majority are doing under 5.
Oh, on the relative return, you mean?
On the relative return, yeah.
Right. Yeah. So you're basically talking about the companies that have been the investment institutions that have been the most successful versus the market. Yeah. And a lot of these, like for example, well, another thing that jumps out at me here, Barron Partners Retail is one of the top funds, and we're going to actually take a look at a couple of these at the top of the chart. And he hangs out a lot, as the name suggests, in retail or discretionary. And one of the things that kind of grabs me right now is, you see Vanguard Discretionary up here. That's simply a sector fund, and this is a close cousin right here. If you want to posit, could the recession be winding down? Is it possible that people are going to get out there and actually do some shopping or continue to do shopping? This is basically suggesting that potential is there. Perhaps not in the next few months, but over the long term, could be just fine. And so I just found it kind of interesting that those shopping or retail-centered funds actually ended up so high on the list. All right, so what we do is we basically take every one of these, starting at the top, and kind of go through them looking for opportunities. So here's the first one on the list. That this is one of the Morgan Stanley funds. It's actually been kind of crunched, kind of like Cathie Wood, here over the last year or so. But in the poor performance here lately is what causes the 1-star rating. So this is a fairly highly regarded fund. Morgan Stanley has a fair number of these, and I don't work for Morgan Stanley. They don't give me any money for saying that. But what we literally are looking at here is the top 20 funds. And what I've done for the funds, like we did last week, is go into I think this one actually has 80 or 90 holdings, and actually drill down beyond the top 20 holdings that are on display here, and look for the companies that have been purchased this year. So during 2022. And so these are companies which I would assume are in the style or the mold of some of these names. There's several names on here that are fairly well known to us, some new ones. But these new additions down at the bottom, again, purchased during 2022, and probably worth a closer look, especially if we're not covering them. We will be adding them to coverage. And I just think it's a great place to go shopping for new, smaller company ideas to study.
Mark, there's a little confusion. You got this chart directly from Morningstar's pages?
This one is actually from Y charts, the actual top 20 holdings, and all of the data is manifest investing.
Okay, where would they find when it was purchased?
You'd have to actually go to Morningstar, and there's a column that says first purchased.
Okay, so if you do go to the original source, you'll come up with a chart that won't have these same numbers on it, but it will give you a when it was purchased date, right?
Yes.
Or when it was first purchased date.
Right.
Okay,
So
that should help some of you that are looking to do that. And Mark is suggesting in those names at the bottom down there that these are some of the ones that were recently purchased in this fund right here.
Right. And what Ken and I will have to do over the next several days is answer the question, is it a great story? Is it attractive? And does it qualify for small company consideration? Like, I know this one looks good. We've mentioned it a few times. I don't think it's small.
I know it's not. I own this stock, ASML, and I
Right.
know that it's not small. So, yeah. We're getting a couple of questions, and it's lagging our slides a little bit, but I'm going to take it.
Mm-hmm.
They want to know a little bit about InMed, INMD, and all I'm going to indicate is that the company is involved in plastic surgery, and it's involved in women's health issues. You can get a pretty good thumbnail just by going to your Better Investing data feed and looking at the thumbnail. They also have a fairly decent investor presentation on their company website. This is not a pure plastic surgery play. They make a lot of things that have to do with gynecological products, a lot of things that are directly for women's health. And they have a third division that is escaping my mind at the moment, but it is quite a unique kind of company. You don't see many competitors, direct competitors and peers for InMode. So I would suggest you go right to their website and start with their investor presentation. And if you want a briefer explanation, go to the Better Investing website and call up InMode and look at the thumbnail that's there. You'll get some good information. I don't think InMode is covered in Value Line, and in fact, I'm going back to that slide that you just pulled up, Mark. It has an asterisk, and that means it's not covered in the main Value Line. Mm-hmm. It's covered in an extended Value Line. Yeah.
Okay. So that's the first fund that we look at. And again, these guys are kind of renowned for their longer term track record, much like Cathie Wood, for coming into some of these companies. You see Datadog up at the top. I believe this is DoorDash. And then this one here is Trade Desk, which is a Motley Fool favorite. So some there. So let's take a look at that number one fund. This is actually the top ranked in terms of performance over time. And you can see how very quickly, you can see how they got there, much like Cathie Wood. Half of their firm is Tesla. Half of the fund is Tesla. So this one actually is a pretty fertile ground of ideas, as evidenced by Illumina. That's kind of a community favorite, one that Ken has mentioned from time to time. I added FIGs to coverage here fairly recently. So it just smacks of retail, and even outside of the dominance of Tesla, pretty good track record.
And again, not focused necessarily or for the most part on small companies. I mean, Schwab, FactSet, those are definitely not small companies. Mm-hmm. So you're going to have to do your homework as you move through here and try to sort out whether you have candidates for that small company list or not.
And I think we talk about FIGs last week? These numbers are elevated. I would certainly be careful with them, but certainly are interesting to think about and scratch one's head over. I do want to figure out who, or if there is any potential with this VELO 3D. Don't know anything about the company unless you do, Ken.
Nothing at all, Mark.
Definitely
Nothing.
want to take a look. And I think that StubHub Holdings is still private, maybe with a pending IPO. I'm not certain of that, but I certainly know that company.
That's the question that I'm being asked here by somebody. That space exploration up near the top, does that mean it's there, but it doesn't have any numbers to attach to it because it's not a publicly traded company?
I need
Is
to
that
dig in a
what
little bit. I ran into some, yeah, I need to figure that out. I
I
think,
think that if StubHub is private with no numbers, that might be what's going on with these bottom two, that VLD and the space exploration, or maybe VLD just went public real
well, VLD
quickly.
is just not covered by us yet. So
Yeah.
it may not be coverable. So we'll find out. But Airbnb, a lot of people here know about that one. My incredibly successful home away investment for the roundtable a few years ago is actually embedded in Airbnb now, I believe. All right, so that fund is there again. Very unusual fund, really, to say the least. Here's the one that we wanted to cover last week. This one's a little more traditional. These are going to be the type of companies from top to bottom that resonate more closely with your heart, I think. One of the things I did want to point out is in many of these, when you look them up, you end up running here. This is cash, everybody, cash equivalent. And it's the fifth highest position in the fund. And it's kind of their way of getting around of listing it as just cash, because this gets kind of listed elsewhere or whatever. And I don't know if they even double count or what. But anyhow, it's a fairly large cash position for Baltimore's T. Rowe Price New Horizons. But there are some companies here that we have enjoyed some moments with, including Globant. It's been featured in some of our successful investing sessions. And you can see they've been fairly active with companies they've bought. Now, they're not all small. Ken mentioned this one last week, so we're going to make sure that's on the list if it qualifies. Monolithic Power.
My wife owns Florin Decor in her IRA account. I don't know the size of it, but I do know that we're very pleased with it as an investment.
Yeah, that one stacks up pretty well, especially with the economy and stuff that's been going on. And I'm personally intrigued by and hoping that either Revolution Medicines, that RVMD, or Ventex Biosciences might actually qualify for a little closer look from this particular fund. So again, you find these type of names by going, my favorite place is Morningstar, going into the actual portfolio, scrolling through the portfolio, looking for, well, when did they actually buy it? When were they actually interested and compelled to buy the company? And hopefully fairly recently being within the last year or so.
Mark, Len Douglas is suggesting that Velo 3D might be a direct competitor to Proto Labs.
Okay.
And we certainly did a lot of work on Proto Labs at various times.
Mm-hmm. All right, and here's one of our other favorites, which has had a really rough year. That's why they are down to 2 stars. A couple of really tough years. One of the reasons we like this one is it's not referred to as small cap. This is a true small company fund. Also notice the cash here that they have, a fairly large cash position, somewhere in the 3.5% range of total assets. But the thing which cratered these guys is and I'm editorializing and expressing an opinion here, they have refused to consider the financial sector. And those of you that have been around here for a while know that what Ken's selections for the best small companies have done for us over the last couple of years, these guys waited through the last couple of years without any of that cover and a buffer from some of the really nasty stuff. I mean, we have some off the charts companies that have, your Western Alliances was the leader a couple years ago, and we just have had some real bolstering by the financial companies, the asset-based companies that we have had in the portfolio. And I'm kind of intrigued by all three of those at the bottom. They're fairly small positions in this fund. These guys have a very low turnover rate when you go in and look at when they bought some of these companies. How about this one, Ken? They bought a lot of these companies 10, 20, 30 years ago. And you just don't find that. And then we're going to talk about Hoover's a little bit. That's what I discovered Alarm using Brown, using this very fund, alarm.com and Hoover's a few years ago. And that has done very well for us in a couple of different places. So this is, again, they think like us. They maybe are a little bit more frisky on the front end of some early stage companies, and that's probably what we'll find down here. But these are certainly worth at least putting on your radar and digging in and figuring out. And I'm hopeful that one of them might actually make my finalist list going forward.
Mark, I'm getting a question about, does the Morningstar site tell you when a holding was last purchased? In other words, do you get the additions to a particular holding as part of that site? Does it tell you that they added more stocks or anything like, or more shares, that kind of thing, and when it happened?
Well, they of course give you the change over the last quarter, so you can actually look for an accumulation. I did not do that. You could look for a really heavy accumulation of a company that you already had owned for years. Like, say, for example, they were loading up on Neogen that they first bought, let's say, 15 years ago. So yeah, you can actually watch and look for what are they accumulating the heck out of these days. So that in combination with these new ones, and again, I'm just pointing those out as nudging us as new discoveries.
Yeah, the reason I'm being real tentative on the Morningstar site for those 2 or 3 of you that are asking this question, the reason I'm being real tentative is that Morningstar has, for the last 3 or 4 months, been gradually changing their site to their new vision of what it should look like. And I've been burned a number of times since convention by telling people one thing and then finding out that it's completely wrong and Morningstar has changed it on their site. So my best advice to you is to go to the Morningstar site and see what's there when you look at it on that day. I've been disappointed that some things that I really like, I had to completely relocate once they've made all their cosmetic changes. They don't seem to have made anything disappear from the site, but they've certainly buried some things in places that are not immediately intuitive, at least to the way my mind works. So I just would suggest you go to the site and see what you can come up with. We're also getting a couple people, not only Len, but a couple of other people are telling us that VLD makes metal 3D printers. In other words, printers that print metal rather than a plastic kind of a situation.
Interesting. All right, we'll keep trudging along then. All right, let's just kind of close up with a quick look at Hoover's Handbook of Emerging Companies. I'm almost halfway through it, and I haven't found anything yet that jumps off the pages. But I just wanted to point out this has been one of my favorite sources going back to the 1990s. Literally, we took the paperback version of this handbook and at an investment club meeting, literally around the living room, sitting around the living room, around the fireplace, and tore it into 16 separate pieces, handed out the 16 pieces. Obviously, we owned the book and had bought the book, but basically sent away every club member and said, come back if you find anything interesting. And that has actually been a pretty compelling source of ideas over the years. In fact, it's where we discovered Cisco Systems, not the food company, but the technology company, CSCO, in the early 1990s. And man, are we grateful. Now, if you go out and you try to buy the current version of it, either the 2021, I'm not even sure the 2022 is out, This is the price tag, and that's discounted, and it's also out of stock. But if you actually will back up a year or two, and it's still just as good a list to go through, the prices are like $4 and $8. So obviously that's being frugal. That's what I did. I actually went back and got the 20. What do I have here? I got the 2019 version, and I spent $4 for it. And it's the hardback, so I can't tear pages, or I could, but it'd be really hard. But one of my favorite sources of ideas for exciting growth enterprises. Here's a look at what the pages look like. And again, you've got a couple hundred companies that qualify for this. And this is just an excerpt of a page. It shows you that there's a narrative for the company. And this is one of Ann Manning's favorites, Align Technology. She presented it down in Dallas. And just very quickly, what you're doing, I'm literally thumbing through page by page. One of the really cool things is I'm actually reliving moments like Alarm.com and a few others where it's worked out pretty well. And the emphasis is basically on, well, what's the story? And then, Ken, this is where your eye would head. Do they have revenues? Do they have profits? And you see that they do. So you're literally going through generating this picture with your brain and looking for this type of a story to pursue. This was a good one. Nice list of competitors there also. So it's really an exercise that I would recommend for investment clubs and individual investors to get a fairly copied, deeply discounted version of this and go for a closer look. And I certainly will be sharing over these last few days any ideas that pop out of the book that we're not currently on top of. Your thoughts, Ken?
It reminds me of going through the extended value line every quarter and looking for companies that had revenues moving up and earnings moving up. So it's anywhere you can get this kind of depth of company lists is a good place to go mining for ideas.
So we'll let you know if anything else turns up. But like I say, most of them are just warm moments of, man, am I ever glad I discovered that company back when. Here's one I thought I was really on to one. Chemocentrics Inc. I'd never heard of it. CCXI is the ticker. You can see that the stock price has been doing pretty well, but unfortunately, and this is only 4 days ago, Amgen liked it so much they agreed with me. So this one's going to be gone pretty soon, but they're obviously doing some pretty solid work in cancer, autoimmune, and
this is quite a coincidence, Mark. I listened.
Going to tell me you own this one.
No. I listened to a guy really solidly, really hot on Amgen this morning, and I thought, well, I want to go see what he has to see, and I pulled Amgen up and I got the news on this Chemocentrics. First time I'd ever heard of it. I wasn't particularly impressed with Amgen, although they do have quite a pipeline. But this Chemocentrics seems to add a whole new flavor to their cancer drugs. So maybe you do want to give Amgen another look.
Yeah, I have a feeling that this fits very well into Amgen and their presence in the market. Be interesting to hear Mr. McManus's thoughts on this one, because you can read it over here for yourselves. They're in some very critical areas. So good stuff, but again, late to the party. But that's one that would have caught our attention. They actually have some sales and earnings also. Right, here's our regular reminder that we do archive all of these presentations, including our roundtables, which again is tonight, all bull sessions. And then if we have any special educational sessions also, please consider subscribing. We'd greatly appreciate it, and you'll be notified anytime new content is added. So with that, this is actually from this morning in our neck of the woods, and a friend of mine from our tennis league sharing a picture from her back door. And that was pretty cool. All right, and this was the companies last week that we shared. I just left it in there. The Forbes best small companies list currently. So anything else you want to add or kick around, Ken?
No, just to invite everybody to come to the roundtable this evening. Looks like we're going to have at least 4 presenters and maybe 5. And we hope you'll get some great ideas as you come and listen to us talk about some of our favorite stocks.
I thought one of the things we might do is just go real quickly and show people. It might actually work better to do it through this door. Just want to show it's running a little bit slow just because things are starting to stack up here a little bit, but just looking at a particular mutual fund in this case and clicking into the portfolio.
Mark, can you press that maximize button in the upper corner up there and maybe get it even a little bit bigger? Oh, that's minimize. Okay, never mind.
It's for some reason it is not remembering me.
Okay.
That's weird. Well, I guess we'll save that for another day. I don't know what's going on here. All right. So with that, I guess we'll come back to it.
Okay.
That's kind of strange behavior. Maybe too many things running at once. So with that, I will get ready for tonight's session on the round table and go from there.
Good night, everybody, or good afternoon. And
good afternoon. See some of you.
Hope to see you tonight.
Thanks, Ken.
Thank you, Mark.